sharp move. By the way, the market is also making a very sharp move. It's now down in the red. It's down 10 points, by the way. So that's quite a move that we've had from the day's highest level. You know, the move on the Nifty, I guess we can blame on the rupee. But what's causing the move on the rupee, we're not very sure. And the move, by the way, is extending. So it was 82.75, 77, came back to 75, 80, back to 75, and now 82.8225. So that's a new high for the dollar against the rupee at this point in time. And look at the Nifty, which I think is reacted largely to what's happening on the currency. So these are moves that are happening as we speak. Rajeev Thakkar is Chief Investment Officer and Director at PPFAS Mutual Fund. Rajeev, great to have you with us here on the program. Thanks very much. You know, I don't know if you have any view on the aggregate market. We can talk about what you like in the market in a bit, but what's your sense? How is risk reward with time on your side looking from here?
So if I were to look at it from a longer term time frame and zooming out a bit, we have not seen a rising rate scenario for a very, very long time, almost a decade and a half or 2 decades. So some of the very premium valuation in select sectors and stocks, I think, are looking very, very vulnerable and risky in the coming years. So if the earnings growth doesn't keep up, or if the estimates are not met, and sometimes even if estimates are met, you could see either a price correction or time correction. So that is for a select pocket of consumption-facing names or some of the newer listings and things like that. But in the same market, there are sectors which are at reasonable levels, specifically private sector banks, where balance sheets have been cleaned up quite a bit and valuations are not demanding. So in the market, you are finding both pockets. You are finding pockets of severe overvaluation, and you are finding pockets where there is a reasonable amount of opportunity. Broadly, India is doing well in this overall turbulent times. Since the war is not on our shores, domestic manufacturing is picking up. We are poised for a cyclical turnaround in some of the sectors like auto and so on. So broadly, India is looking reasonably okay in an otherwise turbulent world.
Rajeev, but can India continue to do well? Because there are a lot of economic linkages, and not just to direct IT and the technology stocks. So for instance, when IT doesn't do well, real estate in Bangalore, for instance, will get affected, which will then affect cement and building materials, etc. So there is a trickle-down effect which impacts everyone. The tax collection gets impacted, which may then impact how much the government can spend in terms of capex, etc. So when the times are turbulent, as you called it externally, can India continue to hold up even at these levels? Or do you think, we've tried to run hard, but from here on, if things get worse on the global front, India could, catch up on the way down?
Absolutely, Reema. I'm completely in agreement with this thought. And we are not an island anymore. And increasingly, the country of listing does not matter. So you mentioned sectors like IT, but even otherwise, even a sector which is domestic, otherwise, let us say a company is manufacturing steel in India and selling in India, but the price may be determined in overseas market in terms of import parity and things like that. Also, a lot of Indian companies have large overseas subsidiaries. So just to take a random name, let's say Tata Motors will not be only dependent on their sales in India. They own Jaguar Land Rover, and they may have overseas sales as well. So whether it's Hindalco with its overseas subsidiaries, or Bharti Airtel with its African operations. So today we live in a globalized world, and given the fact that Indian market has been very, very resilient when other countries have fallen, I think there may be a time for mean reversion where India takes a breather while other countries recover, or we may come down together with the other markets.
Hi, Rajeev. Nigel on this side. Rajeev, I'm looking at your portfolio. You have some of those high-flying tech names in the NASDAQ. Some of the big names in the alphabet, have Amazon, etc., Meta, and all of them. And on the flip side, you have some of those so-called value buys here in India. the dividend yields, relatively safer stocks, the Coal India's, NMDCs of the world. What's your positioning now, from here on, given that we have some global headwinds? It appears the domestic environment, though, continues to remain healthy. Would you be leaning more towards the growth-led names? Or do you think that you'd still look at some of these value names?
So, Nigel, given the steep falls in stock prices that we have seen in the international tech space, some of the erstwhile so-called growth names are looking at maybe just about double-digit multiples, and they are probably cheaper than some of the value names in India. So I think the dichotomy between value and growth seems to have gone away, and the pessimism is so high globally that a lot of these tech names, which have otherwise grown at 20% kind of top line, bottom line over many years, they are now barely about double-digit multiples, or in some cases 15 times earnings or 20 times earnings. So I think the opportunities are there in both markets. We are trying to invest wherever we see opportunities, and some of the longer-term trends in terms of move towards digital advertising, e-commerce, cloud computing, streaming media consumption, that will continue in the future as well, despite the near-term worries on a US recession, etc. So that accounts for the overseas investments. And in India, for a long time now, we have been somewhat cautious on the consumption-oriented names, which have been quoting at very, very high valuations. So that's why you find some of the PSU names or some of the otherwise very, very low valuation companies in the portfolio, where one does not see too much risk, and the cash flow yields are very, very strong, which give a downside protection plus a reasonable upside possibility.
The 82.86 now on.
It's not stopping. That's
it's
what I was
not
saying.
stopping.
Yeah, I mean, that's from the time, I think when we spotted it had moved. Nigel first spoke about it at when we began. I think it's moved another 12 paise or so. So that's a 0.6% kind of a fall. All of it coming in the last 40 minutes, maybe 30, 40 minutes or so of trade. So one assumes one thing is clear, that the RBI is not in the market on the other side, and that is one reason why this is not stopping, I mean, at least at this point. We'll try and actually get more perspective and see. We had Bhaskar Panda of HDFC, who was equally surprised watching the move, but he did mention that it's not led by huge volumes or anything. Maybe the market was caught short, and there is a bit of short squeeze once some levels were taken out, etc. Rajeev, our earnings, you did mention earnings, right? So for FY24, at one point, not very long back, the street was saying, well, Nifty earnings should be closer to 1,000. I think now if you do a poll, people will be closer to 900. Some would say, well, it'll be great if we do 900. So there's been a fair bit of paring back which has happened now. What's your own assessment? How much are earnings at risk, or you think, I mean, that process is just starting? Unless something changes globally, we may see more paring back.
So, Prashant, I don't have a very clear answer for this. The simple reason being that we don't cover all the Nifty 50 stocks, and we don't have earnings estimates for all the sectors and all the companies which form part of the index. So we cover a select group of companies, and we are in the active fund management space. So we would have a better handle on the companies that we are invested in or that we are tracking. So in the companies that we cover and we track, I don't see too much of a cause for worry. So if we look at the financial space, I don't think there is a problem of increased credit costs, or there's no problem of margins being under pressure or credit growth not being there. If we look at the IT services companies, there would be some tailwinds on account of the rupee depreciation against the US dollar. Of course, rupee has not been doing that much badly against other currencies like pound or euro or other currencies. So there may be a small tailwind for IT services. we are not pessimistic on the demand scenario. So despite all the talk of recession and stuff like that, I think IT services should be broadly okay. In the pharma space, it will be more driven by individual company factors, be it US FDA inspections, clearances, or pricing trends in individual molecules and stuff like that. Auto, we see a rebound coming somewhere, so we are actually positive on that. And generally speaking, the input costs should not be too bad, given that most of the commodities are off the highs that we have seen in the past and are coming more towards reasonable levels. So I'm not too pessimistic on the earnings front broadly.
Rajeev, thank you very much for that. Today, at least, IT stocks are getting punished. The Nifty IT index is down 1% despite the support coming